हेलो फ्रेंड्स, वेलकम टू माय चैनल. दिस इज सीए राखी अग्रवाल. आज का हमारा टॉपिक है इंडियन अकाउंटिंग स्टैंडर्ड 33 विच टॉक्स अबाउट ईपीएस, दैट इज अर्निंग पर शेयर. हाउ टू कैलकुलेट अर्निंग पर शेयर. Indian accounting standard, that is Ind AS 33, talks about the earning per share. So let's start our topic. Firstly, we will understand what we will going to discuss in this standard. In this standard, what was the content of this standard, discuss the objective of this standard, then we will discuss about the scope, then we will discuss some important definition related to this standard, measurement of basic EPS, then concept and computation, then treatment of certain items, numerator, how to treat certain items in numerator like after tax preference dividend, increasing rate preference shares, repurchase of preference shares, early conversion of preference shares. Then we will discuss about the 1S, that is weighted average number of equity shares, that is in denominator. Then we will discuss questions and illustration of basic EPS. Then we will discuss about the date of issue of shares. What was the date of the issue of shares? Then we will discuss about the one in case of bonus issue, in case of right issue. Then we will discuss the buyback of shares and EPS. Then we will discuss the measurement of diluted EPS, option warrants, then presentation of EPS, disclosure part, how EPS is to be presented in the financial statement. Then we will discuss about the participating preference shares, financial instrument with EPS, consolidated EPS. Then we will discuss about contingently issuable shares. So this topic is divided into 3 videos. So we will discuss today about the objective of this standard, then scope, then measurement of basic EPS, then how to compute 1Rs, then what is 1Rs, what is the basic EPS, definition of basic EPS, along with important examples. Then we will discuss about the 1Rs in case of bonus issue. Today we are going to discuss that much only. In the next video, we will continue our topic with this, with some of the contents. So let's start. Introduction of these standard. What was the importance of these standard? What these standard says? Earning per share is the method used to review the performance of an entity. Why EPS is important to calculate? Because if you calculate the EPS, the entity get to know its performance during the financial year, how it performed. The performance is generally reviewed this method by calculating EPS of the entity. The performance of the entity is to be reviewed. So earning per share is the method used to review the performance of an entity. Then it simply means determining the profit attributable to each. What was the profit attributable to each shareholders? So such information is required to understand the returns on investments for the shareholders and prospective investors. So without this, the people won't understand now whether the company is working well or not. They will invest on, the shareholder will invest on that entity or not. That's why this information is to be reflected in the first page of the financial statement, that is the basic EPS and diluted EPS, like in the financial statement, in the balance sheet part. Now, what is the objective of these standard? इस standard का purpose objective क्या है? The objective of these standard is to provide a common parameter for reviewing the performance of the entity and compare the same. Every year they find out, they calculate the EPS in order to review the performance of the entity, and they will compare with the previous year whether the entity is earning EPS is more than the previous year or not, whether the entity is increasing its profits or not. Also, the computation can be used for reviewing the performance of entity between different periods. What is the scope of the standard? स्कोप क्या है, इसके अंदर क्या क्या आता है? This standard requires that if an entity compute earning per share, then it must calculate and disclose the same as per these standards. So if the entity compute earning per share, they should calculate or disclose as per Ind AS 33. Further, these standards require that if an entity present both consolidated financial statement and separate financial statement as per the standard, then it must present the earning per share in both the statements separately. So if they are a group company and there is a subsidiary holding relationship and they prepare consolidated financial statement and separate financial statement, so they should prepare their EPS as per India's 33, and it must be presented in both the statement. In consolidated statement also it is presented, and in in separate financial statement also it should be disclosed. The standard prescribes two methods for measurement of earning per share, that is basic earning per share or diluted earning per share. Now basic earning per share, what is the definition of basic earning per share? Basic earning per share will be calculated by dividing the profit or loss attributable to the ordinary equity holder of the parent entity by the weighted average number of ordinary shares outstanding for the period. सो बेसिक अर्निंग पर शेयर क्या है कि आपके पास जो प्रॉफिट बच गया है, लेफ्ट आउट प्रॉफिट आफ्टर गिविंग द टैक्स, after paying to the preference shareholders, after paying to the debentures, after paying the dividend, whatever the left out profits are there, that should be divided by the weighted average number of ordinary outstanding for the. This computation enables in understanding the earning attributable to each shareholder. That is net profit attributable to equity shareholder divided by weighted average number of equity shareholders. Now EPS is based from the perspective of the class of equity shares which is subordinate to all other equity shares in the capital structure. Means in the capital structure there are preference shareholders, there are cumulative preference shareholders, there are non-cumulative preference shareholders, there are debenture holders, they are in the liability side. So after paying all the liability, whatever the profit left out, it should be divided with the weighted average number of equity shareholders. What do you mean by weighted average number of shares? This concept is to be explained with the help of example, that is one. Suppose A or B, there are two companies are there. Net profit attributable to each shareholders in A is 10 lakhs, in B also 10 lakhs. Shares outstanding as on 1st January 2024 is 10,000 in both the cases A or B, and at the closure, that is the financial year end on 31st December 2024, and the outstanding shares held by A is 90,000 and held by B is nil. Now they said that please calculate the EPS. So 10 lakh divided by 1 lakh, EPS become 10 rupees. If we directly divide by adding on the opening and closing balance, that is 10,000 plus 90,000 becomes 1 lakh, and if we find out that is net profit attributable to equity shareholder divided by 1 lakh, it becomes, in case of B, 10 lakh divided by opening plus closing, that is there is no closing, that's why we had taken the opening balance only, so it becomes 100. 10 lakh divided by 10,000 becomes 100. Now whether these reflect this calculation, this method of calculating EPS reflect a correct picture, because the opening shares as on the 1st January 2024 is 10,000, and as on the closure date, that is their issued shares on 31st 12 2024, that is 90,000 on that date. So whether it's reflecting a correct picture to calculate from the beginning, taking 90,000 from the beginning of the year, no, it does not reflect a correct EPS in case of company A. So how we will calculate? We will give the time factor on this issuing of shares. So that's why the calculation of weighted average number of shares is important. To give the weightage by dividing the number of shares with the company issue with the period they hold. So 10,000 they hold from the beginning of the year. So full year 90,000 is to be calculated for only one day because it is issued on 31st 12 2024. So 10,000 is the opening balance in which we take, if we give the time factor on 10,000, that is into 365 divided by 365. It becomes 10,000 only. And in 90,000, we will take only one day effect. One day time effect, that is 1 divided by 365. Then it gives the proper weighted average number of shares. This way, weighted average number of shares is to be calculated. That is 10,000 into plus 90,000 into 1 by 365. So it becomes 10,247. In the case of company is only issuing of shares on the 1st January 2024. So 10 lakh is directly divided by 10,000 into 365 divided by 365. So it becomes 10,000 only. So now the EPS, the correct EPS becomes, in case of company A, 10 lakh divided by 10,247 equals to 97.59. Now it's 2 EPS earning per share of the entity A. Now in entity B, there is 100 only. 10 lakh divided by 10,000 becomes 100. So that's why weighted average number of shares is important to calculate, because if weighted average number of shares is not there in the standard, if it will not talk about the weighted average number of shares, the company directly add the total number of shares in whatever day they issue and divide, so it does not reflect the correct EPS in the financial statement. This concept is explained with the help of example, that is net profit attributable to the equity ordinary equity shareholder divided by 1/2, that is weighted average number of equity shareholders. The net profit before tax of Moon Limited was rupees 400 lakhs and income tax rate was 30%. The company's preference share capital has the following classes, that is 12% of non-cumulative preference share capital 400 lakhs, 10% of cumulative preference share capital, that is 600 lakhs. In its account, Moon Limited has provided or paid following dividend on preference share capital. Means Moon Limited has provided, they provide and paid, means they declared and paid the dividend on preference share capital on non-cumulative preference shares fully declared for the current year. Non-cumulative is that kind of shares you have to declare and you have to pay. You won't be able to cumulate that share. The dividend on that shares is not been cumulated. That is to be declared and paid. And cumulative preference shares are that shares. In cumulative preference share, what happened? You are declared that dividend during that financial year, but you can able to pay that shares after 2 years or after 3 years. That is not the issue. So the company also provide for dividend distribution tax 12.75% and transfer rupees 8 lakhs to the general union. You are required to calculate the net profit for the period attributable to the equity shareholder. The solution is profit before tax computation, rupees in lakhs. What was the profit before tax? It is given in the question that net profit before tax of Moon Limited 400 lakhs. So given in the question, that is 400 lakhs. Less tax expense. How much tax they are going to pay? The income tax rate is 30%. So 400 into 30, so it becomes 120 lakhs. So 400 minus 120 lakhs, profit after tax is 280 lakhs. Now less preference dividend for the period. What dividend they had declared and paid during that financial year? 12% non-cumulative preference share capital, that is 400 into 12%, that is 48 lakhs. That is on non-cumulative preference shares. And on cumulative preference shares, 600 into 10% is 60 lakhs. Now the dividend distribution tax 48 lakhs plus 60 lakhs at the rate 12.75%. So 12.75% it becomes 13.77. So after giving the tax After giving the preference share dividend, they declared for non-cumulative and cumulative, and on that different dividend distribution paid tax, whatever left out, that is net profit for the period attributable to the equity shareholder. These profits are attributable to the equity shareholder, which is to be divided by the weighted average number of shares. Calculating the net profit attributable to the shareholders. In this way, we will calculate the net profit for the period attributable to the equity shareholder. Note, dividend on cumulative preference shares for the prior year. So, and transfer to the general reserve should be ignored in under Ind AS. Means dividend on cumulative preference shares for the prior years and transfer to the general reserve should be ignored under Ind AS 33 in computing the net profits for the period attributable to the. Now, measurement of basic EPS. What was the measurement? How basic EPS is to be measured? Treatment of certain item in computation of numerator for basic EPS is after tax amount of preference dividend includes, and also what they include after tax preference dividend, what they include after tax preference dividend declared in respect of the period on non-cumulative preference shares. In this case, non-cumulative preference shares fully declared for the current year, and after tax preference dividend required for the current period on cumulative preference shares, whether or not dividend has been provided. And what it excludes is excludes dividend on cumulative preference shares paid or declared during the current year in respect of the period. Measurements of basic EPS. Increasing rate preference shares, meaning preference shares that provides for low initial dividend to compensate an entity for selling preference shares at discount. If you are selling any preference shares at a discount by giving, मीन्स सपोज आपने एक प्रेफरेंस शेयर्स इशू किया, वो डिस्काउंटेड रेट पे इशू किया, सपोज 100 रुपीज का शेयर 15 रुपीज जो है आपने डिस्काउंट में इसको इशू किया है, तो वो जो 15 रुपीज होगा जो इन्वेस्टर्स नहीं पे कर रहे हैं 100 रुपीज के शेयर्स में, उसको मान लेंगे कि वो इनिशियल डिविडेंड है. Initial dividend, low initial dividend to compensate an entity for selling preference shares at discount. क्योंकि अगर स्टार्टअप्स हैं, those are the startup companies. They issue preference shares at a discount because they want to run their business. And at the first stage, they won't be able to declare dividend to the investors. And investors also want dividend every year because they also, if they invest something, they want something from the company. So company says that at the initial stage we won't be able to declare dividend because we are not in the position to declare dividend at the initial stage, because at the pre-construction stage, at the initial stage, the company is growing. So at the growing stage, they won't be able to declare dividend. After 5 years or 10 years, if the company grow virtually, means grow in that position that they will able to declare dividend, they will give the dividend to the investor. But at the initial stage, they won't be able to give dividend. So what they do, they issue preference shares at a discount. So it will be benefited to the investors also and to the company also. Company also receive money because for investment purpose they require money to run that 15 rupees at the initial stage. You will consider it as a dividend for the period, for the time period when I will grow, I will declare dividend. Company issue preference shares at a discount rate and investor treat it as a dividend. At an above market dividend in the later period to compensate investors for purchasing preference shares at a premium. So after that, after certain period, an above market dividend in the later period to compensate investor. They want to compensate investor for purchasing preference shares at a premium. Now treatment, an original issue discount or premium on increasing rate preference shares is if they declare at a discount then amortized to the retained earning using effective interest method. And if they issue at a premium, then they will treat as a preference dividend for the purpose of calculating EPS. If they issue at a premium, the treatment will be treat it as a preference dividend for purpose of calculating EPS. And if they issue a discount, then that discount is to be adjusted with the reserve. Retained earning amortized to the retained earning using EIR method. Illustration 2 related to the concept which we had discussed earlier. A company issue a convertible non-redeemable class A cumulative preference share of rupees 100 par value at the beginning of the year 1. These shares are entitled to a cumulative annual dividend of rupees 7 per share starting in year 4. At the time of issue means they had issued a cumulative preference shares at the beginning of year 1, but they had declared dividend in the year 4. Because it is a cumulative preference shares, they are entitled for the dividend every year. But in this question, what happened? This is a startup company, so they are only able to give dividend at the beginning of the year 1. So what they did, they issue the shares at a discounted price. The price of the preference shares is 100 par value, but they issue at the discounted price. So in the question, what happened? The shares are entitled to a cumulative annual dividend of rupees 7 per share at starting at year 4, because at the beginning of the year 1 they will not entitled to get the dividend. The market rate dividend yield on such shares was 7% per year. Compute the following issue price of the preference shares. Because it is a cumulative non-redeemable convertible preference shares, which means it will be non-redeemable, means it will not redeem in future, and convertible means it will convert in equity shares, and cumulative means even the company is not in a position to declare dividend in some years, but they can accumulate the dividend, and when the company has started earning, they will declare the dividend of the past years also, in which they accumulate dividend at the beginning of the year. Your dividend is to be accumulated. We will declare, instead of giving a dividend, we will give you a shares at a discounted price. So issue price, present value of 100, discounted at 7% for 3 years. Because first 3 years we are won't be able to give dividend at the rate 7%. So they can give, the investor can purchase share at a discounted price. So the par value of the shares is 100. It will be discounted at 7% for 3 years. Instead of giving dividend, they will issue a shares to the preferred shareholder at a discounted price. So 100 divided by into 1 divided by 1.07 to the power 3. So it becomes 81.63. So they issue shares at 81.63. On that they accumulate dividend, because it is a cumulative dividend, cumulative preference share, they accumulate dividend. So in the year 1, carrying amount of the preferred share at the beginning of the year, they issue shares at 81.63, that is a discounted. They imputed dividend on at the rate 7%. So 81.60 into 7%, that is 5.71. Carrying amount at the end of the year becomes 81.63 plus 5.71. So it becomes 87.34. Dividend is not paid in the year 1. They had already said that we are paying dividend starting in year 4. So they issue shares at a discount instead of paying dividend. So 87.34 is the opening in the second year. They impute dividend at the rate 7%. So 87.34 into 7%, that is 6.11. 87.34 plus 6.11, it becomes 93.46. Dividend is not paid in this year also. In year 3, 93.46, which is the closing balance in the year 2, it becomes the opening in the year 3, and imputed dividend, that is 7%. 93.46 into 7%, that is 6.54. So at the year 3 it becomes 100, that is the par value of the shares, and dividend is not paid. Thereafter in year 4, when it becomes 100, the dividend on 100 is 7%, that is 7. That 7 rupees is to be paid in year 4. So 107, and the 7 is the dividend paid by the company to the preference shareholders. In year 0, bank account debit to preference share capital, that is 81.63. It will be issued by the company to the investor at a discounted rate. In year 1, interest is to be computed on that. So preference dividend account debit to preference share capital in year 1, 5.71. In year 2, preference dividend account debit to preference share capital, 6.11. It will be accumulated to preference share capital in first 3 years. That is in year 3 also preference share dividend account debit 6.54 to preference share. In year 4, it will be paid preference share dividend account debit to bank by 7. Now illustration 3. Illustration 3 is related to how to calculate the VANAs, that is weighted average number of shares. That is how we will calculate the denominator, which is the number of shares in which the VANAs net profit attributable to the shareholder, which is the numerator, is to be divided with the denominator. Denominator is weighted average number of shares outstanding during the end of the period. So in the financial year, Ravi Limited issue rupees 80 lakhs equity share at par on 15 December 2023. It has a bought back rupees 20 lakhs equity capital at par on 1st March 2024. The equity capital was 150 lakhs at the end of the year 31st March 20. Calculate the weightage average number of equity shares outstanding during the period if the face value of the equity share is rupees 100. In this question, everything is mentioned that on 15 December 2023, the company has issued these 80 lakh equity share, and the face value of each share is 100. So you can calculate, that is 80,000 shares during the year. They had buyback shares 20 lakhs, that is the 20,000 shares they buy back, because amount of shares they buy back is 20 lakhs, rupees 20 lakhs, and the face value of each share is 100. So it becomes 20,000 shares they buy back. And closing value is also given, that is 150 lakhs at the end of the year. So how to compute the opening balance? Opening balance you don't know. You know the closing capital. 150 lakhs is the closing capital. You know fresh issue during the year, the transaction happened during the year, that is 80 lakhs. You know the buyback happened during the year is 20 lakhs. So now the formula of calculating the opening capital, because in this question opening shares, number of shares are not there. So closing capital is there, opening capital is not there. The opening capital plus fresh issue minus buyback, that is the formula. So you know the closing capital 150 lakhs equals to opening capital, you don't know. You know the fresh issue, that is 80 lakhs minus buyback is, because company had buyback their own shares from the investors, that's why it will be reduced. So minus 20 lakhs, therefore the opening capital becomes 150 lakhs minus 80 lakhs plus 20 lakhs. So it becomes 90 lakhs. 90 lakhs means the face value of per share is 100. So it becomes 90,000. Now we will make one table that to compute the weighted average number of shares outstanding during the period. We give the weightage factor on this. So on the opening on 1st April 2023, the company is having 90,000 shares. The value of that shares is 90 lakhs. And number of equity share is 90,000 for a period of 12 months. So time factor is 90,000 into 12 divided by 12. So it becomes 90,000. Now in December 23, in 15 December 2023, the company issue a fresh issue amounting 80 lakh rupees. So the number of shares is 80,000. The time period factor is for how many days or for how many months of December and 3 months for January, February, March. So it's 3.5 months divided by 12. Company buy back its shares on, so it will be reduced. Company buy back its shares on 1st March. So that amount of shares is to be reduced. So on 1st March 2024, the company buyback rupees 20 effects is to be given for 1 month. So 1 divided by 12, so it becomes 1666. And for 80,000, the time effects is to be given, that is 3.5 divided by 12, so it becomes 23,333. Total number of weighted average number of equity share after giving the time weighting factor. So weighted average number of equity shares outstanding during the period becomes 1,11,666.67. Now we will calculate the EPS. How? Because the net profit attributable to the equity shareholder is 10 lakhs. Calculation of EPS 10 lakhs divided by 1,11,666.67, so it becomes 8.96. In this way, we will calculate the weighted average number of shares by giving the time weight factor on the number of shares held by the entity. Another approach to calculate the weighted average number of shares on 1st April 2023, the equity number of shares is 90,000 for a period of 8.5 months from April, May, June, July, August, September, October, November and half months of December. After that, the entity issue a fresh issue. How much? 80,000 shares. So on 15 December, company issue fresh issue, that is 80,000 shares. So 90 plus 80 it becomes 170. Now we will calculate on 1,70,000 shares 2.5 months, because half of months of December and January, February. So it's 2.5 months divided by 12. On 1st March 2023, the entity buyback 20,000 of its shares, so it becomes 1,50,000, because 170 minus 20,000 it becomes 150 for a period of March, because buyback happened in March, so time and waiting factor is to be given for 1 month, so it becomes 12,500. Now the total weighted average number of outstanding during the period is 1,11,666.67. These two ways to calculate the weighted average number of shares. You can follow any one of them which you find suitable. So these are the two ways to calculate the VANAs. Calculation of EPS, the answer will be same in both the approach. Calculation of EPS is 10 lakhs divided by 1,11,666.67. So answer becomes 8.96%. Now illustration number 4. Compute weighted average number of shares in the following cases, like date of issue on 1st April 2023. Opening balance of equity share is 5 lakh. During the year, that is on 30 June 2023, the equity share issued for cash, that is 1 lakh. On 15 January 2024, the company buyback of the shares of 50,000. Now, the opening cash during the year fresh issue 1 lakh, 6 lakhs. Buyback happen of 50,000, so it becomes 5 lakh 50,000. It becomes the closing balance as on 31st March 2024. Now, how to calculate the weighted average number of shares? Compute weighted average number of equity shares outstanding during the period. So on 1st April 2023, the entity is 5 lakh shares. So period outstanding is 12 months. Time weighing factor is 12 divided by 12, so it becomes 5 lakhs. Now on 30/6/2023, the company issue 1 lakh shares. Period outstanding is now 9 months. Time weighing factor is 1 lakh into 9 divided by 12. So it becomes 75,000. Now on 15 January 2024, the company buy back 50,000 shares. So time weighing factor is 2.5 months. How? Because January, half month, February, March, 2.5 months. So 2.5 months divided by 12. So it becomes 50,000 into 2.5 divided by 12. It becomes 10,416. This buyback is to be reduced. So 5 lakh plus 75,000 minus 10,416. So it be weighted average number of equity share outstanding during the period. It becomes 5,64,583.33. In this way, you will calculate weighted average number of shares outstanding during the period. Now, during the year ended 31st March 2024, JK Limited makes a public issue of 1 lakh equity shares of rupees 10 each, which was fully subscribed. The calls were made as rupees 5 on application and allotment made on 1st July 2023. Rupees 2 on first call made on 30th September 2023 and rupees 3 on second and final call made on 1st January 2020. Partly paid shares are entitled to participate in the dividend to the extent of amount paid. It means if you had paid for on 1 lakh shares rupees 5, so it becomes 50,000 shares fully paid. 50,000 shares fully paid, not 1 lakh, because you had paid 5 rupees. So on 1 lakh equity shares, so it becomes that shares become 50,000 shares become fully paid shares. Partly paid shares are entitled to participate to the extent of amount they paid. Means if they paid 5 rupees, so they will entitled for a dividend to the proportion of rupees 5 only. The company has 5 lakh shares outstanding at the beginning of the year because company has opening balance 5 lakh shares, and apart from the public issue which was issued during the year, public issue of shares made above, there was no other changes in the share capital structure. Compute the weighted average number of shares, equity shares, for calculating the basic EPS. So we have to compute the weighted average number of shares for calculating the basic EPS. So by preparing a table, we will compute the weighted average number of shares outstanding during the period. On 1st April 2023, the opening balance is 5 lakh shares. Proportion of paid up is 100% they had paid. So 10 is the value of the shares. So 10 by 10 it becomes 100% fully paid shares. So period outstanding is for 12 months. So 12 months, 12 by 12 is the time weighing factor. So 1 hour is weighted average number of shares for that share is 5 lakhs. During the year, company issue 1 lakh shares. The proportion for that shares is paid to 5 rupees on application and allotment. So 5 divided by 10. 5 divided by 10. So it becomes 50% shares is to be paid. So 50,000 shares is to be paid, fully paid up. It was issued on 1st July. So July, August, September, October, November, December, January, February, March. 9 months. Time weighing factor is 9 divided by 12. So it becomes 37,500. On 30th September 2023, first call amount is to be received by the entity from the investors on 1 lakh shares. On 1 lakh 2 by 10, that is 20% amount is to be received. So it becomes 20,000 shares. On 20,000 shares, the time weighing factor is October, November, December. January, February, March. 6 months, 6 divided by 12. So 20,000, 6 by divided by 12, it becomes 10,001. On 1st January 2024, rupees 3 is to be received on second and final call on 1 lakh shares. So 3 divided by 10, so it becomes 30% amount is to be received on final call. So 30,000 shares for 3 months. Time weighing factor, it was the amount received on 1st January 2024, so it becomes 30% share become fully paid up. 3 divided by 12, time weighing factor, it becomes 7,500. So weighted average number of equity shareholders outstanding during the period becomes 5 lakhs plus 37,500 plus 10,000 plus 7,500. So it becomes 5 lakh 55,000. Alternatively, bonus could be calculated using the timeline method as discussed. So in this way, we will calculate the weighted average shares during the partly paid shares amount on if the entity received partly paid shares. In this way, they will calculate. Firstly, they will make that partly paid to be fully paid, and then they will give the time weighing factor to calculate the one. Now, measurements of basic EPS. As we had discussed, we will just give a theoretical explanation of that. Whatever we had discussed to calculate the weighted average number of shares in the denominator, weighted average number of shares is to be in the denominator, and numerator will be the profit attributable to the equity shareholders. This denominator is weighted average number of shares outstanding during the. Firstly, step 1, determine the number of ordinary shares outstanding at the beginning of the period, as we have discussed by giving 2-3 examples. Step 2, determine number of ordinary shares during the period and dates of respective issue, when at different dates the share is to be issued. We will determine by giving the weighted average factors on different dates. Then determine number of shares to be buyback, how much shares is to be buyback and on what date. We will giving that by giving the time weighing factor of buyback also, and by reducing that buyback from the opening balance and from the fresh issue. And then we will determine the time weighing factor outstanding. Whatever the shares are there, we will put a time weightage factor outstanding on pro rata for the number of issues. We will give all the shares by giving time weighing factor on a pro rata basis, and then weighted average number of shares, step 1 plus step 2 minus step 3 into time weighing factor, that is step 4, multiplying individually. We will explain with the help of example, with the help of tables, that for every shares opening balance, fresh issue, we will give the time weighing factor for each and every item individually to calculate the one-us, that is the denominator, weighted average number of shares outstanding during. Now, illustration 6, compute basic EPS for the financial year ending on 31st March 2024 from the following data. From the following data, we need to calculate the basic EPS for the financial year 31st March 2024. Firstly, on the beginning of the year, that is on 1st April 2023, equity share outstanding, the face value of that shares is 100, which is fully paid, that is 10,000 shares. On 1st June 2023, the entity issue a fresh issue, which is partly paid, means amount paid only rupees 70 up to 70. Partly paid shares are there amounting to rupees, means number of shares issued are 10,000. On 1st July 2023, the entity buyback shares of 4,000. On 1st November 2023, issue or shares of fully paid 100, fully paid at the rate rupees 100, that is 6,000 shares. So tax for the year is 30% and net profit becomes 12 lakhs. And preference shares dividend is 5 lakh 85,000. So we will calculate basic EPS from these data. Firstly, we will calculate net profit after tax after giving preference dividend. That is the net profit before tax is 12 lakhs. Less tax paid is 30%. That is 12 lakhs into 30%. It becomes 3,60,000. And we will pay preference. After that, we will pay preference dividend, that is mentioned in the question, that is 5,85,000. So it becomes 5,85,000 is also reduced from net profit before tax. So from 12 lakhs we will reduce the tax component. We also reduce the preference dividend 5,85,000. Then it becomes the net profit attributable to the equity shareholder, which becomes 12 lakhs minus 3,60,000 minus 5,85,000. 2,55,000 is the profit which is attributable to the equity shareholder. Now we will calculate the weighted average number of shares. Now on 1st April 2023, an entity issued 10,000 shares which is fully paid up. The proportion of paid up is 100%. That is 100 rupees is fully paid up. So it becomes 100 divided by 100. It becomes 100% share. So 10,000 into time weighing factor by divided by 12. So 10,000. Now on 1st June 2023, an entity issue another shares of 10,000 which is partly paid up to rupees 70. The face value of that shares is 100. So it becomes 70 divided by 10,000 shares on 1st June 2023. Entity issued 10,000 shares. Proportion of paid up is 70 divided by 100, that is 70%. On which we will give the proportion of paid up. So it becomes 7,000 shares which is fully paid by giving 70% effect on that. So 7,000 shares is fully paid for a period because it was issued on 1st June 2023. So it will be outstanding for a period of 10 months. 10 divide time weighing factor is 10 divided by 12. So one has become 5,833. Now the company buyback 4,000 shares on 1st July 2023. Now on 1st July 2023, company buy by 4,000 shares. The face value of the shares is 100. So the proportion is 100 divided by 100. So 100%. 4,000 total is to be buyback for a period. It was buyback on 1st July. So 9 months will be calculated. The time weighing factor is 9 divided by 12 into 4,000. So it becomes 3,000. Now on 1st November 2023, company issue another 6,000 shares of face value 100. Proportion of paid up is 100 divided by 100. So 100%. 6,000 is 100% fully paid shares for a period of 5 months because it was issued on 1st November 2023. So for a period of 5 months, time weighing factor is 5 divided by 12. So 6,000 into 5 divided by 12, it becomes 2,500. So total weighted average number of equity share outstanding during the period is 10,000 plus 5,833 minus 3,000 plus 2,500. So it becomes 15,330. After calculating weighted average number of shares, that is 15,333 to be divided. 255 divided by 15,333. So EPS becomes 16.63 per share. Now illustration number 7. Compute the number of equity shares during the financial year 23-24 for calculating basic EPS from the following data. On 1st April 2023, the equity number of shares outstanding, that the face value shares is 100. The opening balance is 1 lakh number of shares. On 15th June 2023, they issue a shares of rupees 100. That is number of shares they issue is 75,000. On 8/11, that is on 8th November 2023, they had converted the preference shares, convertible preference shares to equity shares, that is 50,000. On 22 Feb, they buy back a shares of 20,000, and on 31st March 2024, means opening, that is 1 lakh is the outstanding balance at the beginning of the year. 75,000 is the fresh issue. 50,000 is the convertible from preference shares to equity. 2,25,000 and 20,000 shares is to be buyback. So 2,05,000 shares become the closing outstanding at the end of the year 23-24. Now how to compute 1 hour? That is weighted average number of equity shares outstanding during the period. On 1st April 2023, the number of shares issued is 1 lakh, that is 1 lakh shares. Period outstanding up to 31st March 2024 is because we are taking the number of days in this situation, because the dates which are given in the question, the issue date, the conversion date are not in that fraction in which we take the month. It is a fractional date. That's why we are computing with the help of number of days. If the dates are like 22nd December, 8 January, if the dates are something like that, then we will calculate the weighted average number of shares by taking the number of days calculation. But if the dates are like end of the month, like beginning of the month, like mid of 15th of the January, like 1st of the February, like 31st of the March, like these type of dates are there, then we will calculate with the help of months by taking the time varying factors in months. But if the dates are like 8th of February, like 22nd of July, like this type of dates are there. Now, that means the dates are not to be fractioned. Then we will calculate the weighted average number of shares by taking the calculation on the basis of number of days. So in this case, we are considering the period outstanding calculation on the basis of days, that is 365 days. On 1st April 2023, the number of shares issued by the entity is 1 lakh. Means the opening balance at the beginning of the year is 1 lakh. So it should be calculated for a period of 1 year. So 365 days. Time varying factor is 365 divided by 365. So it becomes 1 lakh. Now on 15 June 2023, the entity issue a fresh issue of 75,000 shares. So 75,000 shares, the period outstanding is, we will calculate the number of days from 15th of June to 31st March 2024. So it becomes 290 days. So 290 days divided by 365, the time varying factor becomes 0.7945. Multiplied by 75,000, it becomes 59,589 number of shares. Now on 8/11/2023, the entity convert the preference shares to equity, that is 50,000 shares. 50,000 shares is to be converted. Number of days from 8 November 2023 to 31st March 2024 becomes 144 days. 140 time varying factor becomes 144 divided by 365, it becomes 0.39 multiplied by 50,000, so it becomes 19,726.027. Now the entity buyback on 22nd February 2024, 20,000 shares. So buyback is on 22nd of February 2024. 20,000 shares, it will be reduced, so it will be in bracket 20,000 shares. Period outstanding is from 22nd February to 31st March 2024, it becomes 38 days. Time varying factor 38 days divided by 365, 0.10. 1 hour becomes 2082.192 in negative because it will be reduced. Weighted average number of equity shares outstanding during the period 1 lakh plus 59,589.041 plus 19,726.027 minus 2082.192. So it becomes 1,77,233. These shares had already been considered in the share issue. The same has been deducted assuming that bought back shares have been extinguished immediately. Now, deciding the dates for the issue of shares. Now, when ordinary shares are issued in exchange of cash, then date when cash is receivable. If, if the entity purchased or issued shares in exchange of cash, then date when cash is receivable. On voluntary reinvestments of dividend on ordinary or preference shares, if they reinvest the dividend on shares, then the date when dividends are reinvested, the date when dividends are reinvested into shares, that date is to be taken. As a result of conversion of debt instruments to ordinary, if the debt instruments is converted into ordinary shares, the date when interest cease to accrue means the date when debt instruments are converted into equity and they are no more accruing any interest. So the date when interest cease to accrue, that date is to be considered for issuance of ordinary shares in lieu of interest or principals on other financial instruments. The date when interest cease to accrue. If the ordinary shares are issued exchange of principal or interest on other financial instruments. So the date when interest cease to accrue. When the ordinary shares are issued in exchange of settlements of liability. If any liabilities are there, an entity want to settle by issuing its shares. So the date of issue is the date when settlement is happening. When the shares entity issue a share as a consideration for acquisition of an asset other than cash, if the entity issues shares by acquiring any other assets other than cash, then the date on which acquisition is recognized in the books. When the entity issues shares in exchange of rendering services to another entity, the date when services are rendered on exchange of that service, the entity issue shares to the, that case was the employee shop was the case. If the employee are giving their services to the entity and entity on exchange of that service issue e-shop to the date when service are rendered. As a part of consideration transferred in case of business combination. If an entity issues shares to another entity in case of business combination as a part of consideration, the date of acquisition, that is, since acquirer incorporate targets PL upon the conversion of convertible instruments, the date when the contract is entered. In case of mandatory convertible, the date when contract is actually entered. If entity issue a shares by way of bonus, by way of share splits, if the entity issue any shares to its investors by way of bonus or by way of share splits, then the date, what date is to be considered for issuance of share? Beginning of the earliest period on which shares behalf the bonus is given. That shares is to that date of shares is to be taken for calculating of the or denominator weighted average. Now we will take another concept like bonus issue. What happen in case of bonus issue? If an entity issue a bonus shares, what happen? How to calculate weighted average number of shares in case of bonus issue or share splits? Compute bonus adjustment factor or bonus multiplier. Restate all shares prior to the date of bonus issue after multiplying with bonus adjustment factor and then compute bonus. Means we have to give the bonus effect on the issue on the shares which are previous prior to the date of issue bonus issue by giving a multiplying factor or bonus adjustments and then compute bonus weighted average number of equity shares. Compute basic EPS for the current year. Now restate basic EPS for previous year using denominator as previous year. One is adjusted for bonus issue share split using the bonus adjustment factor. Now illustration A, that is compute basic EPS as per Ind AS 33 based on the following information. Number of equity shares outstanding as at the beginning of the period, that is 5 lakhs. Bonus issue on 1st October of the current financial year, that is 3 shares for every 1 share held. Net profits for the current financial year is 160 lakhs and net profits for the previous financial year is 50 lakhs. So 160 lakhs is the current financial year profits and 50 lakh is the previous year financial year profits. Now step 1, firstly we will calculate the number of equity shares outstanding at the beginning of the period, that is 5 lakh. Now total number of equity shares, because the entity issue the bonus on 1st October, for every share held, for every 1 share 3 share is to be given. So the bonus effect is to be given from the to the shares which is already issued by the entity. So entity issued at the beginning of the year 5 lakh. So bonus is to be given on that share only. The investor who is holding 5 lakh shares, they will get for 1 share 3 shares is to 3 bonus share is to be given. So in this case 5 lakh is the original number of shares on which the bonus is to be given. 5 lakh into 3 divided by 1, that is 15 lakhs. So 15 lakhs is the bonus share and 5 lakhs is the original number of shares. So total number of shares, equity shares outstanding after giving the bonus effect is 20 lakhs. Now calculation of basic EPS for the current year is 160 lakhs divided by 20 lakhs, because 20 lakhs is the is the number of shares after giving the bonus effect. Means if we calculate directly, then 160 lakhs divided by 20 lakhs without giving the time factor, because in bonus issue the time factor is from the beginning of these shares only, which is outstanding at the beginning of the period. In the mid, though the bonus is issued in the mid, in the October, but the original share for which the bonus is to be given is existed issued by the company as at the beginning of the period. So because the shares are already outstanding at the beginning of the period, the time factor is 12 by 12 only, and for bonus also the time factor is 12 by 12 only, because the bonus which is given by the entity for the existing shareholder only. So 160 lakhs divided by 20 lakhs, so it becomes rupees 8 per share. And previous year EPS is also restated, because in the financial statement both current year and previous year figure is to be given. Comparative figures are also be given. So 50 lakhs divided by 20 lakhs, so it becomes 2.5 per share. Previous year EPS is to be restated by giving the. Now illustration number 9. At the beginning of the reporting period, Advait Limited having an equity share capital 10 crore divided into shares of rupees 10 each. During the financial year, it has issued bonus shares in the ratio 1:1. The net profit after tax attributable to the equity shareholder for the previous and current financial year is rupees 8.50 crores and rupees 11.50 crores respectively. EPS disclosed in the account 2 years is 8.50 and 5.75 respectively. Comment on the EPS calculation above. Because for the current the entity is already disclosed in their financials the EPS for the current year and also for the previous. The entity is asking whether they had made the correct calculation of EPS and not by following Ind AS 33. So let's check it out whether the entity has disclosed the correct EPS in their financials or not. Like in step 1, number of equity shareholders existing equity shareholder at the beginning of the current year. 10 crore is the amount and divided by 10, so it becomes 1 crore. Now total number of equity shares outstanding is, bonus is given on 1:1, so 1 crore shareholder, existing shareholder will get 1 crore bonus. So total number of equity share outstanding after giving the bonus effect will be 2 crores. Even the bonus is issued at the mid of the year, it will be affected on the existing shareholder only. So at the beginning of the year, because during the year there is no such fresh issue, so 12:12 is calculated by giving time weighing factor, so it becomes 2 crore only. Basic EPS for the current financial year 11.50 crore. So for the current financial year, net profit will be 11 crore 50 lakhs divided by 2 crore, so it becomes 5.75 per share. And adjusted EPS for the previous year, that is net profit for the previous year, is 8.50 crores. Yes, and that is 8 crore 50 lakhs divided by 2 crore. 8 crore 50 lakhs divided by 2 crore, so it becomes 4.25 per share. So in the, as the entity is disclosed in the EPS, 8.5 and 5.75 for the current year, they disclose 5.75, which is correct, but for the previous year they disclosed 8.5, which is incorrect as per the calculation as per India's 133 calculation of EPS. Because if the bonus is issued during the financial year and the financial statement is to be prepared, comparative figures is to be given, and in comparative figures the EPS is also be restated in that case. So restated EPS is 4.25 per share, and in this case entity has not restated their EPS. They had presented as it is from the previous year figure. So from the above, it is observed that the company has not restated its previous year EPS as per Index 33. So they has to restate their EPS. Now illustration number 10. X Limited is an entity who made its financials from 1st January to 31st December. On 1st January 2023, an entity having an opening number of shares, that is 10 lakh opening number of shares. On 28th February 2023, they had issued 2 lakh shares at fair value. On 31st March 2023, they had issued bonus shares for one share for every 3 share held. Means for every 3 existing shareholder, they will get 1 share. On 30 November 2023, they had issued another 2,50,000 shares at fair value. Calculate the number of shares which would be used in the basic EPS calculation. Consider reporting date as December end. Solution: on 1st January 2023, number of equity shares outstanding is 10 lakhs. Bonus effect is for every 3 shareholder. For every 3 shares, bonus is given 1 share. So in this case, 1 divided by 3, 10 lakh into 1 divided by 3. Opening is there for a period outstanding 12 months. So time weighing factor 12 by 12, that is 1. So 10 lakhs into 1, for every 3 shares, 1 share is given. So 10 lakh divided by 3 into 1 for a period of 12 months. 3,33,333 is the bonus, plus existing shares is 10 lakhs. So 13,33,333 is the weighted average number of shares at the beginning of the period. Now the bonus, though the bonus is issued on 31st March, the effect is given, bonus effect is given from the beginning of these shares, from the date when the shares is already existing. So in this case, the opening shares is existing on 1st January, and on 22nd February, the fresh issue is to be done, that is 2 lakhs. the effect is to be given on that share only. Means the bonus effect is given to the opening number of shares and the number of shares which is issued before declaring the bonus, prior to bonus. So in this case, 2 lakh shares which is issued freshly by the entity is before declaring bonus, that is on 28th February. So effect is to be given in this share, that is 2 lakhs for one share for every 3 share holding, that is 1 is to 1.33 is the effect for a period because it was issued on 28th February. So 10 months, January, February ends, March से December तक 10 months, it will time 10 divided by 12, that is time being factor 0.833 into 2 lakhs, so it becomes 2,22,220. On 30th 11 2023, they issued 2,50,000 shares at a fair value. Issue after giving the bonus effect, because bonus effect is given to the existing shareholder from the date when they hold the share, and on 30th 11 they issue another fresh issue, that is 2,50,000. No bonus effect because in this case bonus is not declared. This issue is done after declaring bonus. So period outstanding, because it was issued on 30th November, only 1 month left. Period outstanding is 1 month. So 1 divided by 12, so it becomes 0.0833 and 250 into 0.0833, so it becomes 20,833. Weighted average number of equity shares outstanding during the period, how much? 13,33,333 plus 2,22,222 plus 20,833, so it becomes 15,76,389. Total number of weighted average number of equity shares. This is the concept which we had discussed regarding the bonus issue. We had also discussed weighted average number of shares, the concept related how to calculate bonus, weighted average number of equity shareholders. We also calculate how to calculate profit attributable to the equity shareholder after giving tax, after giving preference dividend, after giving the dividend distribution tax. Thank you for watching my video. If you like, please share, subscribe.